This is a breaking news update. Hang tight for the next 60 seconds because you're not going to want to miss this. Whether you hold 100 XRP or 100,000, the next few minutes could decide if you're chasing the move or already in position when it hits. At the time of recording, XRP is trading around $3.08. If you're watching this later, the price may have shifted. Just to be clear, none of this is financial advice. Always do your own research and talk to a financial professional before making any decisions that could put your position at risk. If you are holding XRP, this is the channel you want to watch. Subscribe so you don't miss the next critical drop. Here's the real story almost nobody is telling you. We're watching the rails of finance quietly snap into a new shape. US markets went to T+1 securities settlement, which sounds nerdy until you realize it compresses the time window where risk lives. Less time, less credit floated, more pressure on real-time liquidity. At the same time, instant payment rails keep spreading across banks, and tokenized cash equivalents, think on-chain money market shares and T-bills, are turning into the new hot collateral for moving value around the globe in seconds. What fills the gap between those islands of instant money? A neutral liquid bridge asset built for settlement. Add another under-the-radar shift. Corporates and fintechs are trialing real-time treasury operations. That means treasurers don't want to wait days to free trapped cash. They want intraday movement, multi-currency netting, and automated hedging that triggers on settlement, not on messages that promise settlement. If you're connecting the dots, settlement is the product. The asset that can sit between tokenized dollars, euro deposits, and future CBDC blocks without 1,000 bilateral integrations can become the metered pipe for that flow. Now zoom out. The last cycle revolved around store of value and smart contracts. This cycle is quietly rotating to regulated flow and tokenized real-world assets. You're seeing the early pieces, big funds issuing tokenized short-term credit instruments, banks piloting custodial wallets, exchanges integrating with prime brokers that speak both TradFi and crypto. In that architecture, latency becomes a tax. Whoever reduces it wins volume. Whoever reliably bridges value wins fees. And when a bridge asset's throughput and finality are proven, demand doesn't arrive as hype. It arrives as traffic. The bond market is also mutating. Dealers are managing balance sheet constraints while clients want intraday liquidity against safe collateral. That creates small but constant mismatches. A bank wants instant settlement here. A fund wants intraday netting there. A broker needs to line up flows across time zones. These aren't headlines, they're background hum, but they compound. The moment a neutral rail proves it can clear these mismatches with less friction, flows don't ask permission, they reroute. Here's the suspense. A lot of investors still think of XRP only in terms of price volatility and lawsuits. Meanwhile, builders have shipped things that matter to people who move real money: predictable fees, fast finality, and tooling aimed at settlement and liquidity management. If you're a fund manager, you don't care about memes. You care about how to reduce slippage and shorten cash conversion cycles. That's where a bridge asset with native liquidity engines becomes functional, not theoretical. So what breaks the system in a way that favors settlement-first assets, not a crash, an acceleration? New rails compress time. Collateral speed increases. Tokenized assets create atomic transactions that settle or fail within seconds. In that world, bridges with slow settlement or unpredictable fees get sidelined. Bridges with deterministic performance become indispensable. And that's when pricing models change from what's the hype to what's the flow. Give me 60 more seconds because this is the tell. When infrastructure moves from messaging to settlement, whoever owns the neutral bridge owns the toll booth. If flows double, tolls double. If flows go 10x, well, you get it. The market won't ring a bell. It will just start paying the assets that sit in the middle of every transaction. Right now, with XRP sitting near $3.08, the market is still pricing yesterday's story. The question is whether your bag is positioned for tomorrow's plumbing. Let's talk mechanics, because the difference between an orderly repricing and chaos is the difference between opportunity and regret. Imagine 3 pipes carrying global money: sovereign bonds, equities, and foreign exchange. In the old world, orders move first, value moves later, and intermediaries post credit. In the new world, tokenized instruments and instant payment systems push everything toward delivery versus payment with near real-time finality. That compresses the time that intermediaries can fund gaps. It sounds safer, but it starves the system of the float it relied on for decades. Where does the float come from now? Either you hold bigger cash buffers, expensive, or you net exposures more efficiently, hard, or you use a neutral bridge asset as a just-in-time liquidity layer, scalable. If a dealer needs to settle a euro trade now and a dollar receipt lands in 30 minutes, They need something to span that window without blowing out capital ratios or FX spreads. A liquid bridge that can convert efficiently across corridors is a release valve. That's the business case, not the meme. Here's how an unwind could actually look in practice. First, volatility in one pipe spikes. Say rates jump and bond books need margin. Second, balance sheets tighten exactly when clients need intraday cash. Third, well-instrumented desks route exposure through whichever rail can clear fastest with the least friction. If tokenized cash pools, instant fiat rails, and a neutral bridge sit in the same stack, you get a circuit breaker. Real money can settle through a path that doesn't require waiting for legacy cutoffs. The path that works captures the flow. Now bring in the real actors who care about this. Prime brokers aggregating crypto and traditional exposures under one risk engine, global custodians rolling out tokenization services, and payment processors that already touch millions of cross-border transactions daily. They don't care which chain wins conferences. They care which asset clears repeatedly, without drama, and plugs into compliance tooling. XRP's value proposition lives here, not as a headline, but as the low-latency gasket between pipes. The retention spike, don't miss this next 60 seconds. The hidden trigger isn't a single government announcement. It's a boring operational metric called fail rates. How often settlements miss their window. As T+1 and instant rails proliferate, tolerance for fails collapses. When a desk finds a consistent way to drop its fail rate by routing through a bridge asset that closes the timing gap, that method becomes standard operating procedure. Not because it's trendy, but because it saves capital and reputation. That's your silent catalyst. You'll hear names in this conversation. Global exchanges offering on-demand liquidity, banks piloting instant cross-currency settlement, enterprise networks stitching private and public ledgers. But the label on the box matters less than the function inside it. If a pool of XRP sits in well-governed venues to act as a swing buffer between tokenized cash and fiat rails, participants won't argue philosophy. They'll use what works. Every incremental corridor that standardizes around that workflow pushes demand from sporadic to systemic. The global impact when this standardizes is subtle at first and violent later. Subtle because the first effects are cleaner reconciliations, lower capital charges, and fewer fails, accounting wins. Violent, because once those wins get quantified, everyone rushes to adopt the same playbook, and assets that enable it reprice to reflect throughput, not just narrative. If you've ever seen how quickly market structure changes once a better route is proven, you know that the flood doesn't ask questions, it just follows gravity. If you are enjoying this content, make sure that you like and subscribe this video. It really helps me get the message to the masses and is greatly appreciated. Stay with me, because the best part is next. What happens to exchange supply, custody balances, and liquidity once this shifts from pilot to production? Imagine market liquidity as a shallow lake feeding a fast river. For years, trading venues drew water from the lake, exchange balances, while the river downstream represented real-world settlement. As tokenized instruments and instant rails speed up, the river begins pulling harder. If institutions stand up custody wallets to service settlement and liquidity pools to buffer corridor flow, water exits the lake and stays parked in deeper reservoirs, qualified custodians, treasury-managed wallets, and programmatic liquidity contracts. The lake looks calm until a wind hits and everyone discovers how shallow it's become. This is why the public float can shrink even without a headline supply shock. Assets migrate from hot wallets to custody, from exchanges to programmatic pools that earn micro fees for standing ready. That's good for reliability, but it means that when demand spikes, for example, a new corridor goes live or a large payments processor standardizes on a workflow, the order books move faster than retail expects. It doesn't require conspiracy. It's plumbing. Now layer in ETFs and institutional products. Even if an XRP ETF isn't on your screen today, the playbook is in plain sight. Regulated vehicles, once approved, absorb supply and don't churn the way retail does. They pair with big custodians, they rebalance on schedules, and they remove coins from the hot float. Whether the first product is a trust, a fund, or a synthetic exposure, the effect rhymes. Less tradable supply relative to fresh demand. Price doesn't need a press release to realize the float got thinner. It just feels it. Psychology amplifies this. Retail loves confirmation. Green candles, viral. Clips, big names. Institutions love position. Quiet fills, basis trades, liquidity at a discount. So while retail argues online, desks are already programming their pipes. When netting conditions meet X and corridor latency drops below Y, routes percent through the bridge stack. It's not emotional, it's code. When those routes go live, the lake drains another inch. Let's break the revaluation into phases so you can spot them in real time. Phase 1 is liquidity crunch. Light, exchange balances trend down, custody balances trend up, and spreads tighten during calm hours, yet widen suddenly on flows. You'll see more stepping by algos rather than spikes. Phase 2 is utility scaling. Specific corridors report volume growth, programmatic liquidity earns more fees, and large treasuries publish case studies on improved working capital. Phase 3 is institutional dominance. Flows from funds, banks, and corporates define the daily profile. Retail waits for breakouts that are now controlled by scheduled rebalances and settlement windows. Mini retention hook, then give me 60 more seconds and I'll show you the tell that Phase 2 has begun. Watch for boring announcements. A major processor starts same-day multi-currency settlement for merchants in new regions. A custodian adds automated cross-currency netting. A bank touts reduced FX slippage for corporate clients. Those don't trend on social media, but they are the footprint of utility demand. When those stack up, price won't moon out of nowhere. It will lurch, pause, and stair-step as enterprise traffic finds its rhythm. Another fresh angle the market's missing: real-time risk reporting. Under tighter settlements, CFOs want dashboards that show cash everywhere at minute-level granularity. If a bridge asset plus tokenized cash can give them deterministic timestamps and predictable fees that shows up as better cash conversion cycles, a KPI boards care about. The moment that KPI improvement is proven for one Fortune 500, peers copy it. The bridge asset enabling that KPI is no longer a trade, it's a line item. Before we wrap this section, here's your final tease. The single most underpriced variable isn't a lawsuit outcome or a single partnership. It's throughput monetization, the idea that the asset in the middle of more flows accretes value because it earns tiny fees 1 billion times. When the market realizes it should value the bridge by projected settlement volume, not just circulating supply, you'll see the model shift from can it go to X to what is the cash flow of being the pipe? That's a different conversation, and it's where structural revaluation lives. Let's compare setups without tribal drama. Bitcoin is still the cleanest store of value and pristine collateral narrative. Ethereum anchors generalized programmability. XRP's edge is narrower and paradoxically bigger, deterministic settlement as a neutral bridge between fiat rails, tokenized cash, and future CBDCs, with native liquidity mechanics designed for that job. If the next leg of adoption is about moving regulated value faster with fewer fails, these roles stop competing and start specializing. The question isn't which religion, it's which cash flow. Macro matters, rate cuts, whether a swift 50 BPS or a glide path, are less number go up and more liquidity regime flip. As financing costs fall, balance sheet space opens, risk budgets expand, and enterprises greenlight tech that frees trapped cash. That's the window where settlement-first assets graduate from pilot to production. In every bull market, picks and shovels that remove friction get paid. In digital finance, the pick and shovel is a bridge that clears in seconds and snaps into compliance pipes. Here's the big mistake: treating XRP like speculative gasoline instead of structural tolls. Gas burns hot and fades. Tolls scale with traffic. If tokenized T-bills, instant bank rails, and cross-currency merchant settlement all grow, trends already in motion, the traffic story compounds. When the market re-rates the bridge for throughput, not Twitter mentions, the gap between fair value and price closes in jolts. Why do most miss it? Because structural stories are quiet until they're obvious. Because the best fills happen while everyone argues about the wrong variables. Winners measure what matters first. Fail rates trending down, custody balances trending up, corridor announcements turning into daily volume, and coins steadily migrating from exchange lakes to custody reservoirs. Future vision, no sci-fi. A bank nets URUSD at noon with tokenized cash and a bridge for the basis. A global processor pays thousands of merchants in minutes using the same pipes. An ETF quietly rebalances from custodial pools without touching public books. Fees clip, fails drop, cash unlocks. The asset in the middle becomes as boring and indispensable as your router. Nobody talks about it until it goes down. Then it's the only thing that matters. If you own XRP, understand your edge. Not a lottery ticket, a potential toll booth. If the toll thesis is right, appreciation won't be fireworks. It'll be a staircase as real-world traffic turns on, corridor by corridor. The calm now isn't complacency, it's compression, and compression ends the way springs do. The market won't warn you before it reprices the middleman of money. It never does. When the pipes reroute, they won't ask permission. They'll just flow. Like, comment and subscribe for more, and be sure to come back so you don't miss the next critical finance update.